Most business owners treat business credit like a fire extinguisher. They only reach for it when everything is burning. Smart business owners treat it like a growth engine, and they've been building it for 12 months so that when opportunity shows up, they can say yes in 24 hours. My name is Justin. I'm not your typical CPA. I focus on business growth and finance. Let's go. Let me tell you about the worst feeling in business. You get a call. A vendor is offering you a 40% off on a bulk inventory order, but only if you commit by Friday. You can double your margin on every unit you sell for the next 6 months just by one decision by Friday. But you have to say no, not because the opportunity isn't real, not because you can't do the math, but because the money isn't there. And by the time you could have scraped it together, the window just closed. That vendor went to somebody else, somebody who was ready with the cash. Here's the difference between the business owner and the one who said yes. It wasn't revenue, it wasn't income, it wasn't connections, it was just credit. Specifically, business credit, built strategically over time through a system most small business owners don't even know exists. I'm going to show you that system, 7 strategies starting from a zero. And one of them, I promise you, you can start today before you leave this video. Let me paint the picture of how most small business owners relate to business credit. They start with an LLC, they get that EIN, they even open a business checking account, and then nothing. Zero intentional credit building. They run the business 2, 3, or 4 years on personal credit cards or personal loans and personal guarantees. And then one day, when they need business credit, they go to that lender, and the lender says, "Where's your business credit profile?" The owner says, "What's a business credit profile?" The lender closes the folder and just simply says, "Come back in 12 months." That conversation happens every single day. And the tragedy is, it didn't have to. That business owner had started building 12 months ago, they'd already be approved. The lender isn't mean. The lender isn't racist. The lender isn't rigged. The lender is reading a file that does not exist. Can't borrow against a profile you have never built. You've been running a business for 3 years with an EIN that has the credit profile of a newborn baby. It's not the bank's fault. The bank can't lend to a ghost. Before I walk you through the 7 strategies, you need to know about 2 things that have happened in the last 90 days that make this the most important time in 25 years to build your business credit profile. March 1st, 2026, the SBA eliminated automated credit scoring. For over 25 years, lenders have used something called the SBSS score, the Small Business Scoring System, an automated number that decided in seconds whether your business was qualified for an SBA loan. And on March 1st, 2026, the SBA eliminated it. The entire thing is gone. It's dead. Lenders now have to run manual commercial underwriting, which means a human being is reading your business credit report, your Dun and Bradstreet profile, your payment history, your bank statements. The SBSS used to hide weak credit profiles behind a weighted algorithm. That protection is gone. Your business credit profile is now more visible, more scrutinized, and more important than it has ever been. Coming up on July 4th, 2026, the SBA is going to double the loan limit to $10 million. This one drops on Independence Day. The SBA just announced that effective July 4th, 2026, the cumulative loan limit for 7A and 504 combined goes to $10 million. If you have a 504 loan and a 7A loan, you can now stack both up to a combined $10 million in SBA-backed financing. The businesses that access that window are the ones who started building 12 months ago. July 4th is just 26 days away. What are you doing today? So here's strategy number 1, your net 30 vendor accounts, the invisible credit builder. This strategy is number 1 because it's the only one you can start with zero existing business credit. A Net 30 account works like this. You open a vendor account, you buy supplies or services you already need for that business, and you have 30 days to pay it back. The vendor reports your on-time payment to Dun& Bradstreet, Equifax Business, and or Experian Business. And your business credit profile gets a verified payment history. You just bought something you needed and built credit at the same time, zero extra cost. So here's the sequence. Open 3 to 5 Net 30 accounts in the first 30 days. Pay them on time, every single time. Do this for 90 days. You now have a Dun & Bradstreet Paydex score of 80. And this is the equivalent of a Business 720. The score opens the next tier of credit. Now, the Net 30 is not sexy. It's not a $100,000 line of credit. It's an account at an office supply vendor. But that unglamorous step is the foundation for every other strategy in this list that is built on. Skip this step, everything else collapses. So you've been paying for printer paper and shipping supplies with a personal debit card for 3 years. Those same purchases through a Net 30 vendor account would have built your DMB profile every single month. Same money, same purchases, completely different financial outcome. Strategy number 2, the 0% intro APR business card stacking, the interest-free leverage window. Here's a strategy that Wall Street uses at the institutional level and almost no small business owner uses on their own. Most major business credit cards, Chase Inc., Capital One Spark, American Express Blue Business, offer a 0% introductory APR for 12 to 15 months on purchases. That means you can put 20 to 50,000 in business expenses on a card and pay zero interest for over a year. Here's how smart owners use this. They identify one specific revenue generating expense, equipment, inventory, advertising, that they know will generate more than it costs within 12 months. They put that expense on a 0% card. They build revenue from it, and they pay off the card before the intro period expires. The result? They funded a growth asset with interest-free capital, the bank's money, paying for your growth. So here's the rule. Every dollar you put on a 0% card must have a documented plan to generate more than $1 back within the intro window. This isn't a hack. This is basic capital optimization. The question isn't, can I use a credit card? The question is this the best source of short-term capital for this specific expense? And for many purchases, a 0% intro APR card is the best possible answer. Strategy 3, the receivables bridge. Solve the Net 30 cash flow trap. Here's the trap that's strangling every B2B business owner watching this video right now. You finish a project, you invoice the client, your invoice is due in 30 days. Meanwhile, your suppliers want payment now, and your payroll runs next week. Your rent is due on the 1st, and your receivables, the money you've earned is rightfully yours, is sitting in a client's accounts payable system waiting to be processed. The ones waiting to bill after completion are always the ones feeling profitable and broke. Profitable and broke, that's the most dangerous position in business because it looks fine from the outside until it suddenly is not. So here's the specific tool that you need. A business line of credit, not a term loan, not an MCA, a revolving line. Draw when expenses are due, repay when receivables clear. Pay interest only on what you draw, only for as long as you hold it. Used correctly, you might pay $40 in interest to avoid a $400 late fee in a damaged vendor relationship. That's a 10x return on the cost of credit. A merchant cash advance charges you 30 to 150% annualized to solve this same problem. A business line of credit from a bank costs just between 11 to 14% APR. The difference between those two outcomes is a business credit profile you built before you needed it. Strategy 4, the inventory leverage. Buy more, earn more, pay less per unit. Every product-based business has this opportunity hiding in plain sight. Your supplier has a volume discount. Buy 100 units, $10 each. Buy 1,000 units, $7 each. That's a 30% reduction in your cost of goods. And a 30% reduction in COGS directly translate to a 30% increase in gross margin on every unit you sell. The business owner who doesn't have business credit buys 100 units at 10 because that's all the cash they have. The business owner who has a business credit line buys the 1,000 units at $7, captures the discount, sells at the same price, pockets the margin difference on every single unit. Over a year of inventory cycles, that's tens of thousands of dollars in additional profit, funded by business credit, not by cash they had to sacrifice. So here's the rule: buying inventory in bulk to boost your margins is very smart. The volume discount doesn't care how you fund the purchase. The lender doesn't care what you do with the profit, but your income statement cares very much, and it shows up every quarter. Strategy 5, the equipment accelerator. Revenue generating assets that pay for themselves. This is the simplest logic in business finance. If a piece of equipment generates more revenue than it costs, the credit used to acquire it is self-funding. The automotive shop owner on Reddit last month, $35,000 monthly revenue, completely trapped by overhead and lack of equipment, is the perfect example. She needs a lift, a diagnostic machine, and another bay. That equipment would let her take on more cars per day. More cars per day equals more revenue. More revenue equals more capacity to pay off the credit used to buy the equipment. The equipment pays for itself. The self-funding formula: monthly revenue increase divided by monthly credit payment equals your self-funding ratio, right? So if that ratio is above 1.5, the equipment is paying for itself with room to spare. If it's below 1, you're subsidizing the equipment from other revenue. And that's a risk decision, not a growth decision. The difference between good debt and bad debt isn't the interest rates. It's whether the asset generates more than it costs. A $500 per month equipment payment that generates $1,500 per month in additional revenue is the best business decision you'll make this year. Strategy number 6, the SBA stack, the $10 million window that opens July 4th, 2026. This one is for the business owners who are past the starter stage, the ones who have been building credit for 12 to 24 months, who have established Dun and Bradstreet profiles, have multiple trade lines, and are now ready for institutional capital. On July 4th, 2026, just 26 days from now, the SBA doubles the cumulative loan total to $10 million. That means a business owner who has both a 7A loan and a 504 loan can now access up to $10 million combined in SBA-backed financing. The 504 is for real estate and heavy equipment. The 7A loan is for working capital, acquisition, and expansion. Together, they cover almost every growth scenario a small business faces. The build-up sequence: first, you're going to start with your net 30 accounts. Then you're going to go after your 0% business credit cards. Next, you'll go to your business lines of credit. Then you can go to your SBA 7A, and then to your SBA 504, and then to your $10 million stack. Each step requires the foundation of the previous step. You can't shortcut this ladder, but you can start building the bottom rung today. The SBA doesn't care about your personal credit score as much as it used to. The SBSS is gone. It cares about your business credit profile, your cash flow documentation, and your financial story. The businesses that walk into that July 4th window with 12 months of clean business credit history are the ones who get funded. Start the 12 months now. Strategy number 7, the marketing float. Turn ad spend into a cashback machine. This is the one nobody talks about. Every dollar you spend on advertising is an expense. But if you put that ad spend on a business credit card with a 2% cash back or travel rewards program, every dollar you spend on advertising earns you something back. You're going to spend that money anyways. This card makes it cost 2% less. So here's the math. If you're spending $5,000 per month on advertising, Facebook, Google, YouTube, and you pay with a debit card, you get $0 back. You pay with a business card with a 2% cash back, you get $100 per month back. That's $1,200 per year on money you were spending anyways. But there's more. Your utilization ratio builds every month. Your payment history builds every month. Your Dun and Bradstreet profile builds every month. Your advertising spend, which was costing you 100 cents on the dollar, now costs 98 cents on the dollar and builds your business credit profile simultaneously. So here's the golden rule. Pay the full balance every month, every single month. This strategy only works if you treat the card like a debit card. Spend only what you have, pay it in full on the due date. The moment you carry a balance, the rewards vanish inside the interest charges. Full balance every time. You've been giving your ad spend to Zuckerberg and Google every month, paying 100 cents on the dollar and getting nothing back. This card takes 2 cents of that back. It's not life changing, but $1,200 a year that funds your ebook design, your video equipment, or your first VA, now that's Elevate Money. So here's the big picture. Let me zoom all the way out. Right now in America, there are 33 million small businesses. According to the latest data, 82% of small businesses that fail because of cash flow problems, not because of bad products, not because of bad service, because the money ran out at the wrong time. And the solution to cash flow problem is access to capital. And the barrier to access is business credit. And the barrier to business credit is nobody explained how to build it. That automotive shop owner with $30,000 in monthly revenue who still can't get ahead, the B2B service business that's profitable and broke because clients pay in 30 days and vendors want money now, the first generation entrepreneur who bootstrapped for nothing, grew something real, and then hit a ceiling because the banks saw a business credit file that with nothing in it. These aren't failure stories. These are information gap stories. The information was always there. The playbook existed. The strategies worked. Nobody sat them down and explained it in plain language. A man in this community sent me a message just 2 months ago, and he said, "Justin, I had a contract for $180,000 in commercial cleaning services. I needed a $40,000 equipment to fulfill it. I couldn't get funded. I lost the contract. I've been thinking about it every day since." He didn't lose the contract because he wasn't capable. He lost it because he didn't have a business credit profile that was 12 months old. That $40,000 he couldn't access cost him $140,000 in revenue. The equipment would have paid for itself in 3 months. Now I tell this story because he gave me permission to, because he said, if it stops one more person from going through what I went through, it's worth it. Now this video is for him. The SBA just changed the rules in your favor. The automated gatekeeping is gone. The loan ceiling just doubled to $10 million. The net 30 accounts that build your DMB profile are available today with no personal credit check. VantageScore 4.0 is counting your rent payments. The playing field has never been more level. What it requires from you is a start today, not next month, not when you have more revenue, today. With strategy number 1, 3 net 30 vendor accounts, that's the move. Let's go. So now you have the 7 strategies. Nothing should be holding you back from building business credit. So if you've gotten any value from this video, drop a fire emoji in the chat. If you've gotten any value, drop that fire emoji right now. Hit that like button. Smash that subscribe button. Leave a comment. It helps the algorithms get this video to in front of more people. And remember, to your success. Salud.